Hello, welcome back to this study unit looking at the responsibilities of the firm and how that influences strategy. Now remember, in this study unit we're looking at a view that sees the role of the firm being about maximising the returns it generates for shareholders, the investors and owners of firms. That's not saying that this view says that other aspects of society are not important. What it's saying is that by focusing on generating that value and through paying its taxes, the firm funds other institutions that are able to deal with other aspects of that society. A key part of the strategy that addresses this question of shareholder value is called corporate strategy. And we saw in the last video that focus on the scope and how you coordinate multi-business organisations so that as a combined entity, the performance is greater than if those individual businesses had been operating separately. We finished the last video by introducing a set of tests that Michael Porter advises when looking at what is the right scope of the business, i.e. what range of businesses should that group be present in, that parent be present in. And we talked about how when looking at diversifying into new market and product areas, managers need to look at the attractiveness of that industry they're moving into, whether the cost of entry would cannibalise all the future profits and therefore mean no value is generated. And then finally, the need to keep looking as to if a business unit is better off inside that group than it would be if floated off and owned directly by shareholders or by another parent. In this last test, the question is, which of these generates more value for shareholders? Is ownership via parent A giving more value to shareholders than if the shareholders directly owned those individual businesses? Or is it better for shareholders if the ownership of one of those business units passed to a different parent? Now you'll notice here that the key question is what value does the parent add to each business unit, not what value the business unit provides to the parent. That value shareholders could capture directly. So what added value is the parent adding by being the middleman between the shareholder and those business units? Now this is a question because ongoing ownership of a business unit by a parent incurs both explicit and implicit costs. Obviously, there are the headquarters expenses which have to be shared across the business units within the group. On top of which, a business unit in a group will be subjected to a set of standard controls, reporting and other processes, and therefore that business unit incurs costs in following those requirements which it wouldn't have to incur if it was a separate organisation. On top of which, with more levels of control, the decision speed and the flexibility of a business unit will be reduced. So it may be unable to respond as quickly to market events than it might be if a separate organisation. And finally, business unit managers may have less focus onto the performance of their business unit if that business unit is part of a group. Now, those costs would not be incurred if the business unit was directly owned by shareholders. So hence, the ownership of the parent must create more value than if the business unit was separately owned to offset those costs. Otherwise, the parent, through its ownership, is destroying shareholder value. And more, because those costs are ongoing, the parent has to keep adding more value over time. Otherwise, from a shareholder perspective, it would be better to sell the business unit and realise the gains in value that have already been made. So, how do we assess the value that a parent is adding to a business unit? Well, there is a framework developed by Campbell, Gould and Alexander called the Ashridge Parenting Model. And this looks at the question of how the parent adds value using two dimensions. On the vertical axis, it looks at the level of feel the parent has for the businesses in the portfolio. And on the horizontal axis, it looks at the potential for the parent to add value. Now note that's the potential to add value. So it's about adding more value than has already been created. Now if we look first at the vertical axis, this question of feel. And this is all about how there is fit between the needs of the subsidiary businesses and the way in which the group operates. If there's a good fit between the parent and that business, then there is less risk of the parent destroying shareholder value. But if there's a misfit between those needs and the way in which the parent operates, then there's a much higher chance that the parent is going to destroy shareholder value. Now that fit is determined by a number of factors, such as the management systems that the parent imposes on the group of businesses, the extent to which decisions are delegated, the degree of formalisation in processes and decision making, in the culture and shared mental models that are brought to bear by managers in making decisions, and in the style and skills of the managers in that parent. Now remember from a previous study unit where we talked about path dependencies that the history of firms does matter. So where the group's origins are a big influence in terms of the way in which it operates and behaves and the systems it's put in place. And so if, for example, the history of the group comes from a manufacturing background, where there is a strong focus on formal processes and control by low levels of delegation, and managers take a low risk approach, then the fit between that parent and perhaps an innovative new app company would be very low. The imposition of the standard approach used in the group to that new innovative firm would reduce its effectiveness. So, degree of fit between the approaches in the parent and those needed in each business unit. Turning to the second axis, this potential for a parent to add more value. Now, Johnson and Scholes suggest a number of ways in which a parent can add value, and therefore shareholders will be better off. I'm going to step through these. The first one they describe is a portfolio manager. An example here is Berkshire Hathaway. Now, in this model, the parent is simply acting as the agent for the financial markets. It's adding value through allocating resources more effectively than the financial market could. And out of this we get the notion of the business as a balanced portfolio, where the controls on the individual business units is largely financial. So otherwise they're fairly autonomous in their strategic and operational decisions, but there are strong controls in terms of the financing of the firm. Now, for this type of business, a number of tools have been developed to help managers think about those financial flows across a group of businesses. Most famously, the Boston Consulting Group Gross Share Matrix, or the Boston Box as it's called. Now, this looks at the business in terms of cash flows and looks at the balance between the needs of business to consume cash and their capability to generate cash. And so look to bring balance across the group in terms of those needs. And from that, advise where to invest and where to exit for particular businesses. Not to be outdone by Boston Consulting Group, McKinsey introduced their own grid called the Industry Attractiveness Competitive Strength Matrix. Now, these matrices are used extensively in looking at corporate strategy and allocating resources to individual business units. However, they do neglect the interactions there may be between different business units and between markets. For example, as we saw in the resource-based view, perhaps different business units utilise the same competencies. Or perhaps in terms of the competitive dynamics, a certain business unit protects another one. Now, in today's markets, there are questions about the value of this approach in terms of what it delivers to shareholders. The argument being that shareholders themselves can construct just as an effective portfolio as a parent can. Although in less developed markets, you still see this as a way in which group businesses can generate value. Moving to the second model proposed by Johnson & Scholes, that of synergy managers. Now here, the parent is playing a much more active role and it's focusing on value creation at that business unit level. What it's trying to do is identify synergies between individual business units and then facilitate the sharing of resources between those business units. The example here is Tata and its divisions Tata Tea and Tetley, looking at how those two businesses, by being part of the group, can share resources and competencies and so perform better than they would if they'd been separate businesses. So the parent here is adding value by facilitating the sharing of resources and competencies horizontally across the business. And then the third model for adding parenting value is parental developers. And here the focus is on central competencies that are held by the parent. And then the parent allocates those competencies and resources down to business units to enhance their performance. Example here would be Virgin and its brand. By bringing in business units and relabeling with the Virgin brand, they bring extra value to those businesses. So, interesting difference here between synergy managers and parental developers. Synergy managers are looking horizontally across the business units. Parental developments are looking vertically at passing down centrally held resources to those business units. As I say, typically in a developed capital market, portfolio managers, just managing those financial flows, is seen as delivering less value than perhaps it was in the past. And so typically the focus now is on these second two, i.e. looking at facilitating the sharing of resources and competencies between business units and how competencies, resources held by the parent can be exploited down in the business unit to generate that added value. Now, assessing business units against these two dimensions allows us to map each individual business unit, and the matrix suggests the strategy that should be followed depending on where the business unit maps. Now, where there is a high fit between the needs of the subsidiary business unit and the approach of the group, and where there is high potential for the parent to add value, either facilitating sharing of competencies or using competencies down the business, those businesses are called heartland. And these businesses should be invested in for the future. They're the core of the business. But where businesses do not show a good fit, so there's a mismatch between the needs of the business and the approach taken by the group, and there is little or no potential for the parent to add more value, these map into an area we call alien territory. And here there's no shareholder value creation, and so the group should exit these businesses, either floating it into the market or selling it to another parent. In the other two areas, the approach is less clear. In the top left-hand corner, businesses go into the ballast area. Now, these are businesses where there is a good fit between the needs of these businesses and the approach taken by the group, but the potential for the parent to add more value than it already has is low. Now, here the organisation should be looking at a light touch to minimise that cost of parenting. In the bottom right-hand corner is perhaps the most difficult area, that of value trap. This is where there is a misfit between the needs of the business unit and the approach being taken by the group, but there's lots of potential to create new value. And the advice here is that you should only keep these businesses if you can move them more into the heartland space. Although in doing that, there is a risk. By increasing the fit between the parent's approach and the needs of that business unit, the fit with other heartland businesses may be reduced. So great care is needed here not to end up destroying more shareholder value. Now, this is a parenting matrix for Unilever based on a corporate review it did in the 1990s. For its food and personal products divisions, Unilever's multi-local approach and focus onto country managers fits well with the needs of these markets. Also, its strength in R&D, marketing and branding means there is a high potential for the parent to add more value to these businesses. So these units are clearly heartland, and subsequently Unilever did significant acquisitions to boost these divisions. However, animal feeds and specialty chemicals operate as global businesses and thus are not a good fit with Unilever's approach. Also, the potential to add value was also less than other parents would have been able to generate. Tea plantations also were different from Unilever's consumer products divisions. Hence, Unilever decided to exit these businesses. The matrix can also be used to flag challenges. For example, the potential to add value in mass market cosmetics was declining, moving that business into that alien territory, and it was subsequently split out of the personal products division and sold in 1996. The detergents business was also becoming increasingly global, and Unilever was losing share, so that business was becoming the subject of much debate. So this shows how those assessments of the fit of the parent's approach to the needs of business units and the potential to add more value can be used to assess the portfolio of a group business. Now, in the next video, we will look at another example when we work through what happened with the Aviva acquisition of RAC, the Roadside Rescue Company, in 2005. Now, all theories have their criticisms and limitations, and the parenting matrix is no different. And the challenge is here about whether or not the model sufficiently recognises the linkages between different businesses within the group. So even though a business may be in the alien territory area or value trap area, it may support one of the businesses that is in the heartland area or be a defence against market action of a competitor. Also underlying this approach is an assumption that the market will be more efficient than the firm in allocating resources. This is not always correct, and there are often imperfections in markets that mean that shareholders and their representatives are unable to assess and influence the business as needed. And finally, does the focus on shareholder value truly match the full responsibilities of the firm? And has that focus on shareholder value led to a short-term perspective on performance which actually is damaging to the business and therefore detrimental to other stakeholders and to the wider society? And that's the area we'll look at in the next study unit. Thank you.